this computer for others to watch. Okay, Zishan, can you listen me?
Yes, sir.
Okay, so we start with this topic, which is discounted cash flow. It is also called your DCF technique. You call it, DCF technique. DCF technique means that you find out the cash flows. If you remember that in previous topic, we did our relevant cash flows. Whenever you are doing investment appraisal or project appraisal, it means that you are investing money in some capital project, some non-current assets you are making, or you are purchasing, or you are making or starting a new project, and you have to make a huge investment, and you have to assess whether making this investment is suitable for you or not. Is it worthwhile or not? Should you make this investment or not? So this is the topic which is called you appraise your investment appraisal, project appraisal. It is also sometimes called capital budgeting. So it's the same thing. And what we do that many times, we make this assessment or evaluation based on cash flows, because investors, they are not really interested in profit, because profit is something which can be easily manipulated. Your accounting profit, you've got tax profit, you make a lot of adjustments. So profits you can manipulate. The thing which you do not manipulate or you cannot manipulate is cash. And investors, they say that if we give cash and then we get back the cash, they don't give you anything on paper, they put money in hard cash. So in many investment appraisal techniques, we talk about cash flows, we talk about relevant cash flows, and then we find out the value of the project. And what we are talking here today, our concept here is that we say that a dollar today is not equal to dollar tomorrow, which means that money loses value with time. I'm not talking about any exchange rates. I'm not talking about some, exchange conversions between dollars and euros or dollars and pounds. I'm talking about dollar only. Whatever you can purchase today for $50, the same thing after 3 years, probably you need $60. Like today, if you want to buy a calculator, it is for $50, but the same calculator will become $60 after 5 years. So calculator is same, but you have to give more money. It means that the money has lost value. Now, $50 are not enough. You have to give 60. So dollar is losing value, which means the money is losing value. So that is the concept, that a dollar today is not equal to dollar tomorrow. Now, before I start, I always start this topic with a very simple example. Let's suppose that let's create some hypothetical starting point. We say that, let's suppose that you invest $1,000 for 3 years at 10%. So you are putting your money in bank or somewhere, and you are putting $1,000 for 3 years, and your interest rate is 10%. And the question is that how much it will be at the end of the 3 years. So the period of 3 years, how much it will be. I'm sure that you people know it. I'm just showing you. So you've got here 1,000 in year 1, and what you are going to earn, you will earn 10% profit. So you say 1,000 multiplied by 10%. So your profit here is $100. So end of the first year, your investment is now 1,100. When you move to the second year, in second year, it will be your investment, your profit will be 110, and therefore your closing investment is 1,210. In year 3, this closing investment becomes the opening investment for year 3, and your investment becomes to 1,331. So we say that our 1,000, it will become 1,331 in 3 years period if your growth is at 10%. Now in this question, you have a present value, which is called 1,000, and you have a future value, which is like 1,331, and you have an I, which is your interest rate, which is 10%, and you've got your N. What is N? Can somebody speak? What is N? Yes, Abhilash. What is N?
Number of years.
N number of years. No, N is not number of years. N is
Period.
sorry.
It is period. No.
Number of compounding periods. I'm using the word N is number of compounding periods.
Compounding.
What do you mean by compounding period? Okay, now this thing which we calculated, we call it compound interest. This thing which I'm doing, I call it compound interest. Compound interest. Compound interest means that your interest is earning interest. If you see that in year one, your profit is $100. In year one, your profit is $100, but in year two, your profit was 110 and then 121. This 10% is the same number. This 10% is the same thing. Why are you earning more? You are earning more because your interest has started earning. In the first year, you calculated 10% on 1,000, but in the second year, you are calculating 10% on 1,100. So within this 1,100, 100 was your profit, was your interest. So you call it interest over interest. Compound interest, let me call it like this. Interest over interest. So this is what is happening. Your interest has started earning interest in the year two. That is called compound interest. If you want to do it with simple interest method, in simple interest method, every time this number is 1,000. Every time this number is 1,000. So you get, this is your simple interest. And by the way, we do not deal with simple interest in financial management. We only talk with compound thing. So this simple thing you just forget. There is no need to remember it. It is just, you always calculate interest on the principal amount. So you just forget it. So let me kind of remove it. I don't want to see it. So what is happening that your interest has started earning interest. Now the word compounding means compounding. What does that mean? Compounding means adding, okay, let's call it like calculating and adding interest over principal. So compounding means that you calculate the interest and add it into the principal. Add it into the principal. Now, add it into the principal means that in this case, we said that we are supposing that it was annual compounding. Annual compounding, which means that end of the year, one time you will calculate interest and you will add. So your interest will start earning interest from year two, because end of year one on 31st December, you will calculate how much was my profit. It was $100. You add it on 31st of December, and from next year, it becomes 1,100. So because it was annual compounding, which means that you will calculate interest and add it to the principal one time in a year. And therefore, in 3 years, you did it 3 times. Your N was 3. But if I call it semi-annual interest, let's call it semi-annual compounding. In this our example, N was 3. N was 3 because we were doing annual compounding. If you are doing semi-annual compounding means after every 6 months you will calculate interest. In that case, your N will become 6. Although number of years are 3, but within 3 years, every 6 months you are calculating interest. So it will become 6 compounding periods. So 6 compounding periods. Okay, that was here. Now let's suppose that I say that we have to calculate it for 6 years. Let's suppose I ask you that what will be your investment after 6-year time period. Now that would require a little bit long calculation. So now what you need to do, you need to calculate a formula. You need to do it with the help of a formula. Your formula is future value is equal to present value multiplied by 1 plus I and here I say power n. I put a sign power n. This is the formula. Future value is equal to present value multiplied by 1 plus I, interest rate, into n, which means number of compounding periods. So in our example, we have to calculate the future value. Our present value is 1000 and 1 plus 10%. Okay, let me take it from here, 1 plus 10%. I'm putting the value. Okay, it will not allow me here because its column is different. 1 plus 10%, and I would say power 3. This is your formula will become. So if you want to solve it, and I make it like this, so answer is 1331, which is the same answer which you see here. So with the help of formula, it becomes easy to calculate. Now imagine that this is the same thing, and I'm doing it for semi-annual. Sorry, this is annual. Let's suppose that we want to do the same calculation, but we want to do it for semi-annual. If you have to do it for semi-annual, it means that for semi-annual, what will happen? That your n will become 6 because number of years are 3, but you are doing semi-annual compounding. In 1 year, there will be 2 times compounding. So your n will become 6. But similarly, at the same time, your interest rate will become 5%. Because 10% was for 1 year, for 6 months, it will be 5%. Okay? So now if I have to calculate for this value, and I put it here, and please allow me to remove this one. So if you see the value is more. In this case, in semi-annual compounding, your value becomes not 1331, but 1340. Why does it happen? Why did it increase? Because your interest started earning interest early. When you are doing annual compounding, your interest will be calculated end of the first year, and from second year, your 100 will start earning something. But in this case, you calculate your interest after 6 months, immediately add it into the principal. So your principal amount increases in the 7th month. So you start earning interest much faster because your interest started earning much earlier. Every 6 months, you are calculating, adding your principal, so you get more. Now, if you want to do it on quarterly compounding, let's suppose we want to do it on quarterly compounding. Quarterly compounding means that every 3 months, you calculate your interest and add it to the principal. So in quarterly compounding, you have 3 years, and within 1 year, there are 4 compounding periods. You multiply it with 12, quite fair. But then here it will not be 5%, it will be 2.5%, because 10% was full year, and quarter means you have to do it, you have to divide it with 4. So if you do quarterly compounding, your investment amount even increases. So what do you want? If you go to a bank and you are putting this $1,000 in a bank, and the bank says, I will give you 10% and it will be compound interest rate, what would be your question to the bank? You will ask your banker, are you going to do annual compounding or semi-annual or quarterly? You must ask this question to your bank. And what do you suggest? What is suitable for you? What is better? Should you go for annual or quarterly if you are putting your money in the bank?
Sir, quarterly.
Quarterly you should go. Even you should ask your bank to do it monthly. You should ask your bank to do it monthly for you. So if you do it on monthly basis, so here it will become, how much? 12 compounding periods in 1 year, and 3 years it will be 36. And when it will be 36, sorry, I should put here 36. So it will be 36, and then you will say that 10% divided by 12. So this is monthly interest rate. Now if I put it here, so I'm putting the same amount of money in the bank. I'm not changing my investment. So if you see, I get more money. Are you happy with the monthly compounding, Zishan?
Yes, sir.
I would go for daily compounding. Every day interest should be calculated. Why not? Banks, they do themselves daily compounding. You know, when banks, they charge you interest, I don't know if you have this experience or not. If you have some credit payments and if you do not pay in time, you make a late payment, the bank interest rate immediately goes up because the bank starts going to daily based compounding. Because bank says that, you know, I was expecting from you $1,000 today. You didn't give $1,000 today. You delayed it for 5 years. This $1,000 I would have interest on daily basis. So daily compounding means you calculate interest daily. So this is the process of, you know, compounding, which I have explained to you. Now I go back here. So what happens with us? We have got here $1,000 and the future value. So this was our present value, and the future value of this 1000, the future value of this 1000, you calculated 1331. This is what you have done so far. This process, how it goes, you actually, what you are doing like this. So this is the process which you have adopted, and it called compounding. Compounding means, let me correct my spellings here. Compounding means finding the future value of present cash flow. So your present cash flow is 1000 and you have to find out the future value. By the way, let me just reconnect this thing again, that when I say that $1,000 becomes 1,331 in 3 years, it means that today's 1000 is equal to 3 years later 1331 if your interest rate, growth rate, or inflation rate is 10%. If implicit interest rate is 10%, it means that $1,000 of today is equal to $1,331 after 3 years. It means if you can buy something today for $1,000, that same one thing you have to pay 1,331 after 3 years. For example, if this telephone I can buy for $1,000 today, the same phone will become 1,331 in 3 years' time. So $1,000 today is equal to $1,331 after 3 years if the interest rates are 10%. This is what we learned. So you find this is the formula here, and this formula is for compounding. Compounding means you are finding the future value of present cash flow. We already have spent something like 20 minutes on this topic, and after spending 20 minutes, I must tell you that in our syllabus and mostly in financial management, we do not use compounding a lot. Compounding we are not going to use. We are not interested in compounding, by the way. But it was important to explain you, that's why I explained you. Actually, what we are interested in is the opposite of compounding. We actually are interested in this process. And this process is called discounting. So discounting, we are interested. Discounting means, you know, let me write down here, finding the present value of future cash flow. This is discounting, and we are interested more in discounting because in business, what will happen? You always face the discounting scenario because they will tell you that, you know, you put this money 100,000 today, and you will get some amount of money after 3 years. You will get some amount of money after 4 years. So what is 100,000 today? You exactly know how much it is. It is 100,000. It is absolute, no question on that. But the 200,000 which you will receive after 5 years, now that is a future amount. 200,000. How much it is in terms of today? How much it will be in terms of today? You have to find out the present value of the future cash flow. This is the scope of our financial management, because we always invest money today and we know it is 100,000 today, it is 100,000, no question about it. Our doubts are that the money which I receive after 5 years, it is 200,000. I know it will be 200,000 in terms of calculation. When you calculate these notes, it will be 200,000. But how much is the value? So what is the value? We call it time value of money. Time value. So value of money will be less. Counting will be 200,000, but value will be less. So we have to find out the present value. So the same formula we will use, but we will just rearrange this formula. We'll say that present value is equal to future value, and you divide it with 1 plus I power n. So it's the same formula, but we are just shifting it. We are just rearranging it. Now let me show you what does that mean. For example, in our case, we said that future value was, let's suppose we do not know this 1000. Imagine we don't know. We only know that we will get 1331. This is what we know, that we will get 1331 after 3 years, where the discount rate was 10%, or what you call the interest rate was 10%. And then you want to calculate it, and the answer is 1000. So this is what we are more interested in. Am I clear until here?
Yes, sir.
Okay. So we will be looking at more frequently on the process of discounting, and how do we do it? Discounted cash flows, how does it work? That let's create one small example. That let's suppose that you have a project which requires you to put $100,000 today, and then you will start getting, say $45,000 here in year one, $45,000 in year two, and $45,000 in year three. So these are the three cash flows which you are going to get. Now this is 100,000. I know this is 100,000. There is no doubt about that. But the issue is that I'm getting 45, 45, 45. So it means that you are going to get 135,000. So you will get $35,000 extra. But the issue is that you don't get it today. You don't get it at once. You are going to get it in small parts over the next 3 years. And you know that a dollar today is not equal to dollar tomorrow. And this 45,000 after 1 year, it is not equal to 45,000 of today. This 45,000 which you get after 2 years, it is not equal to 45,000 of today. So you need to find out what are the values, what are the present values of these cash flows. I say we have to find out what are the present values of these cash flows. So how do we apply this process? Let me make a little bit bigger here. So how do I visually see it? I visually see it like this, that I have to bring down these cash flows to the timeline 0. Now you should remember that this is called 0, this is called year 0, this is year 1, year 2, and year 3. And last time in previous class, when we did it on Sunday, I explained to you that year 0 is not 365 days. It's not a full calendar year. Year 0 could be just 1 day. Year 0 is the time period when you make investments. So if I put $100,000 today, my year 0 finishes. From tomorrow, the year 1 will come. And this 45,000 you will receive end of year 1, end of year 2, and end of year 3. And we have to find out that if I discount them here, how much is the value? And you know what you are going to use? You are going to use your same formula here. So it is like FV, future value, which is 45,000, divided by 1 plus, let me put here some percentage, let's call it 10%, discount rate is 10%. So 1 plus, so 45,000 into 1 plus, why it is not putting, it does not allow me. Okay, let's call it 10%. And one. This is your formula here. But when you put it here for the year 2, you just have to put year 2 because it is the second year. And when you put it for the third year here, it will be shown as year 3, this one. Are you clear?
Yes, sir.
Okay. So this number I copy paste here and I put here is equal to, and this number I put here and I put here is equal to, and this number I copy paste here and I put is equal to. So now when you make a total of these two numbers, it comes out to be 119,000. So it means that this 135,000 which you will receive in next 3 years, its present value is just 119,000, because this 45,000 after 1 year, in terms of today, it is only 40,909. This 45,000 is 37,000. This 45,000 is equal to 33,000 of today. Anything which I can buy for 33,000 for today, after 3 years, I have to pay 45,000 for that. And this is called your present value of future cash flows. This is what you call it. You give it a name, present value of future cash flows. This is your investment. So now what looks like that you are investing $1,000. What you are getting, so this is 1,000 and 1,000. It is same. But what you get in future, 3 years, the value is 119,000. So what you are really getting, or what you are really, adding or getting value is only this much, which is 11,908, and this is called your net present value. You also call it NPV. You also call it NPV. So it means that if you invest in this project, the shareholder wealth will increase by 11,908. So please do not tell me that we make 35,000. We only make 11,000. We only make 11,000. Are we clear until here?
Yes,
sir.
Any question, please ask.
Sir, I have.
Yes, please ask.
Sir, so whatever the future cash flow is coming, like here in this question, 135,000 is coming. So this 35,000, this increment of 35,000, we are not going to assume that the shareholders funds are going to increase by 35,000. We are going to calculate it in the present value, and whatever will be the increment, that will be the actual increment in the shareholders' wealth.
Okay. You asked very interesting question, and it is very important as well. But you asked one half of that. Another half I was about to add myself. First of all, their bank balance will increase with 35,000, because imagine in shareholder bank minus 100,000 will go, and then 135,000 will come. So the bank balance of shareholder will increase with cash of 35,000. Cash 35,000 will increase, but the real value will be 11,900, because this 35,000, 45,000 which he's going to get, it's just like if I tell you that I will give you, there is a job opportunity for you which is giving $2,000. So you will be very happy to join it. You say, oh, $2,000 in terms of today, it is a good money. I can live very comfortably in $2,000. But if I say that, you will find a job for $2,000 in 2030, you may not be interested. You say that in 2030, $2,000 would be peanuts. I wouldn't be able to live in $2,000 in 2030, because in terms of 2030, 2,000 would look very little. So they will get 45,000, but we need to find out the value of that. The real value, the real increase in value is 11,908. Okay, this is what you asked and I answered. Now I've got one more question here. I've got one more question here. You know what happened? We got extra 35,000 here. In terms of dollars, in terms of notes, in terms of money, in terms of cash, we get $35,000 more. But in terms of value, you are getting only 11,000 more. So there is a loss in value. What do you see? I mean, I see that, there is a loss in value of something like, I don't know, 24,000. Do you think that 24,000 has gone away or swept away in inflation of 10%? Like I said that physical cash is 35,000, but the value of that 35,000 is only 11,000. So it looks like 24,000 is gone in inflation. Is it true or not? It is not. It is not true. I ask you one question. Everybody is invited to make a comment. That's a very important question. What is this 11908? How do you give it a name? You call it, it is NPV, net present value. It is positive 11908. But what does it tell us? What is it? Anybody wants to contribute?
The present, matlab, whatever the increase or increment that we are getting in the future, its present value in today's terms, like, I think, yeah.
Okay, let me explain you, and please be attentive and be careful, because you will not find it in very clear form in any book. They don't write it so clearly. 11908. Okay, what was our discount rate? At what percentage did we discount?
10%.
10%. So let's suppose this is a project A. Let's suppose that this is project A. And I say that project A, it gives 11,908 net present value, 11,908 NPV, 11,908 more than $100,000. So 11908, what is it? It means that this project A will give 11,908 more than any other project which could have given 10%. Because we discounted it at 10%. Okay? Why did I discount it at 10%? What is 10%? I will explain you this thing also. What is this 10%? Is it inflation, opportunity cost? What is it? So let's suppose, for a moment, let's assume that you are the investor, and I come to you and I say, I've got this project, this proposal, we must invest 100,000 here. And you say that, Mr. Ali, I have this money in the bank and I'm getting interest from the bank. And I say that, how much interest you are earning from the bank? You say the bank is giving me 10%. So this 10% was the return which you were getting for your investment. I say, okay, no problem. I will discount with 10%. I will use this 10% in my calculation. And I come to the number 11908. And I tell you that whatever the bank will give you at the rate of 10%, this project is going to give you 11,900 more than the bank. And therefore, you should accept the project. So 11,908, it is not the total return. It is not the total profit. It is the additional profit. It is the incremental profit. It is the extra profit as compared to 10%. Am I clear?
No, sir.
No? Let's suppose that my NPV becomes 0. Okay. Let's suppose my NPV is 0. So this project NPV is 0. It means that, whatever you invest, 100,000, and the present value of all the cash flows, NPV is 0. So what does that mean? Is this project not giving anything? What does that mean? Is that project not giving anything? No. It means that because I discounted my cash flows at 10%, it means that this project is giving equal return as any other project at 10%. Project still will be giving some profit, but that profit is same as you can earn at 10%. If my project shows an NPV of minus 2,000, what does that mean, minus 2,000? It means that because I discounted my cash flows at 10%, this particular project A, its returns are $2,000 less than any other project at 10%. You already put your money in the bank at 10%. So if you take out money from the bank and invest in this business, you will make less money. You will make 2,000 less than what you could have made in the bank.
Okay, it's a way of saying that
We are
discount.
benchmarking it, we are referring it, we are comparing it with whatever you can get on 10%. So let's suppose that on 10%, from your bank you put money at 10%, and from your bank you put money at 10%, and the bank is giving you X. So this project A, this was bank. So this project A will give you X plus 11,900. And therefore, you say that we should do this project because this project is giving more return than the bank at 10%. That's why I said that please listen to this concept clearly, because in many books it is not explained in so much detail and so clearly. Have to listen with care. I said that that whenever you get NPV 11908, it always comes into your mind, what is 11908? It is not my cash, because my cash will be 35,000 more. What is 11908? Is it my profit? No, it is not my profit. Is it my cash? No, it is not my cash. Then what is it? It is the value. Value what? Value as compared to the any investment which you make at 10%, because you discounted your cash flows at 10%. So this particular project is going to give you 11908 more than any other project with 10% return. And therefore, because it is giving more, you say that we should invest in this project. Okay. Are we clear?
Yes, sir.
Okay. Now, let's see a few other things. Actually, it is very strange what is happening. Why I'm unable to use this thing when I want to put here. Why it is not allowing me my Excel? There is something wrong with my Excel. Let me go at 0.10. Are you people seeing it? Can somebody tell me what is happening with my Excel? Why is it making a mistake?
I don't know, so
it is not allowing me any reference point. I need to use these numbers. Okay. Let's suppose that we discounted it at 10%, right? If we want to discount at 15%, what will happen? So at 10%, your NPV, was 11908, right? So let's suppose that you say that, you know, Mr. Ali, I put money in the bank and the bank is giving me 15%. So I say, okay, no problem. I will discount it at 15%. So I put here 15. Then I come here and I put here 15. So I am discounting at 15%. I come here and I put 15. So now the same thing I should do here. Actually, I should have put here. There was no need to put there. How much is your NPV now? 2745. Or probably you say that, you know, I'm putting money in the bank at 20%. I say, okay, let me do it at 20%. So I discount it at 20%. And if I discount it at 20%, the results will be entirely different. Now it is minus 5208. So what do you understand? If you tell me that, you know, I already have an opportunity in my hand where I'm investing my money at 20%. So I want to take out from that project and put it here. So I say, okay, let's put your money here and see. So when we invest here, we say, no, this project is going to give you $5,208 less than what you can earn at 20%. So it is better not to take out your money, keep your money in that project, because that project is giving $5,200 more. Am I clear?
Yes, sir.
Okay. One thing we saw that as the discount rate is increasing, your NPV is decreasing. So NPV and discount rates, they move in the opposite direction. If discount rate goes up, your NPV goes down because you are dividing it with 15%. So if your denominator is becoming bigger, your end result will be smaller. So are we clear until here?
Yes, sir. Sir,
Okay. Yes, please ask.
this thing that you're saying, ki the as the discount rates are increasing, NPV is decreasing.
Yeah,
It
because
means
with
that.
discount rate you divide. I
Mhm.
mean, if you divide with 1 by 10, or you divide, okay, 1 divided by 10, or you divide with 1 divided by 15. So when you are increasing your numerator, your net result will be a smaller amount.
Mhm.
You are dividing with a bigger number. Okay.
Actually, this discount rate, whatever this 10%, 15%, 20%, it's a comparison to. It's actually comparison to other investment which I could have done.
Yes. Now I'm going to tell you what is discount rate. That's why I wrote here what is discount rate.
So,
Actually, in your somehow in your book, this is your chapter number 11, 12, and 13, which is called cost of capital. They have made it very stupid decision to put cost of capital later. And throughout these 3 chapters, 4 chapters of capital appraisal, we are using discount rate, but they don't tell you. They tell you in chapter number 13, which is very crazy of them. So I'm going to explain you first here. This is a concept from chapter number 13. What is discount rate? Discount rate is actually your cost of capital. Cost of capital, what is your cost of capital? So I'm now moving to a concept from chapter number 13 because that is very important. Your capital, it consists of equity plus debt, right?
yes.
So whenever you put money, invest money in business, your capital is a resource, and all resources have some cost. When you hire an office, you take an office on rent, you pay rent, it's a cost. You hire your sales manager or your accountant, you have to pay him salary, he has a cost. You hire a driver, he has a cost. You use electricity, it has a cost. You use fuel, it has a cost. So everything has a cost. Money also has a cost. Capital also has a cost. Because if I am the manager of the business, I go to a bank and I say that give me $1 million. He says give me 10% interest. He will not give me $1 million for free. He'll say I give you $1 million, you use it for 3 years, but you must return after 3 years this $1 million, plus you must give me some rent of the money. Interest. Interest is rent of money. I say, okay, so you want 10%? He said, yes. So there is a cost of, and that is called cost of debt. Then I come to my shareholders and I say, I don't want to take money from the bank. You guys are shareholders. You put $1 million. You invest in $1 million. So you will say, okay, we will put $1 million, but you must give us some profit in form of dividend. So you also want some return. To you guys, I have to give dividend. So it means that equity also has a cost. So there is a cost of debt and there is a cost of equity. Nothing is free. Let's suppose cost of debt is 10% and cost of equity is 12%. And by the way, equity is always expensive. Why it is expensive, we will learn in chapter number 13. So now my capital structure, I've got here my capital, and within my capital, I have 1 million of equity plus 1 million of debt. This is my capital. I've got capital 2 million. Okay, let me write down here 2 million. So it means that I've got 2 million. Out of that 2 million, I got 1 million into 10%, plus I got 1 million at 2%, at 12%, right? 1 million at 10%, 1 million at 12%. So how much is my average cost? Can somebody tell me how much is average cost? Nobody can tell me. 10% and 12%, what is the average?
220 divided by 210,000.
11%. Half of the money is at 10%, another half of the money is 12%. It is called 11%, right?
Mm, mm,
So this 11% is called my cost of capital, let's suppose. And this is my discount rate. Your discount rate is actually your cost of capital. Cost of capital is that profit, is that rate of return which you have to pay to your investors. I mean, you have to attract funds, you have to attract money, and when you attract that money, you must pay some return, and that return is called cost of capital.
mm.
Am I clear?
Yes, sir.
Okay.
But sir, I understood this
Yes,
thing, cost of capital. But how is it discount rate? Like
I will
I
tell
don't
you. I will
understand.
tell you. I will tell you. I'm
Okay.
not. This is a very interesting topic, and that's why I wrote on group that everybody should be present. Now, imagine that your capital has 1 million of equity debt and 2 million of equity. So your total capital is 3 million. Here your total
Mm,
capital was 2 million. Now, um, if it is 3 million, so within 3 million, you have 1 million at 10% and 2 million you have taken at 12%. Now you cannot do 11%. Before it was equal, 1 million at 10%, 1 million at 12%, you can take 11 average. Now the 12% amount is more, right?
mm,
Now your formula should be 1 divided by 3 into 10%. I'd make a weighted average. Now you call it VAT, weighted average, plus 2 divided by 3 into 12%. This should be your formula. Let me just put it here, and I call it here VAT. This is chapter number 13, but I'm just doing very basics very quickly. Weighted average cost of capital. Weighted average cost of capital, or VAT. Because now I have to take average, weighted average. Because the equity and debt amount is not equal. Equity is more, debt is less. So the money which comes at 12% is more, and the money which comes at 11% is less. So what I do, that I say that, okay, in this case, let me do it like this. Equity I put first and debt I put later. So equity is 2 million out of a total capital of 3 multiplied by 12%. And debt is 1 million out of a total capital of 3 and multiplied by 10%. So this is the formula for WACC. So how do we call WACC formula? Your WACC formula is, I will write down equity divided by equity plus debt multiplied by cost of equity, then plus debt divided by equity plus debt multiplied by cost of debt. So equity 3 million divided by equity 2 million divided by equity plus debt 2 plus 1 3 multiplied by cost of equity. Cost of equity was 12%. Then you say that debt, which is 1 million, divided by equity plus debt, which is 3 million, multiplied by 10%. And now when you will calculate the average of that, let me remove these things. I put here average. And you see that your WACC is now more. It is now 11.3%. You see, how much was before?
11%.
Before it was only 11%. Now how much it is?
12.
11.33. Why it has increased?
Because
Because
cap.
the 12% thing is more, right?
Mm, mm,
And by the way, in the WACC formula, you should also multiply it with 1 minus t. 1 minus t means you get the tax benefit. Now, you just stop it here. 1 minus t means you get the tax benefit and you put the tax benefit whatever. So it's not the purpose here. What I was just about to tell you, because I'm going to use the word discount rate a lot. And you will ask, sometimes students, they ask, what is discount rate? Is it my inflation? No, it is not your inflation. Is it the bank interest rate? No, it is not the bank interest rate. What is it? You can call it cost of capital. It is your cost of capital. Cost of capital means the interest rate, the average interest rate on which you have taken your money. I'll tell you why do I discount it. It is also, by the way, you can call it opportunity cost. Opportunity cost means that at what percentage investors would have, could have, or should have invested it anywhere else. Any question until here, please ask. If not, then I will take 5 minutes break and we'll come back and start. If you want to ask any question until here, please. Left the class. Abhilash is gone. Yes. Anything you want to ask, please? No?
No.
Okay. Give me 5 minutes break and then I'll come back.
Okay.
Start the topic. So we said that this is our WACC, which is called weighted average cost of capital, and this is going to be your discount rate. You call it your discount rate. So you discount any project at this amount. Why this amount? Because this is the return which I have to give to the people from whom I have taken the money. So if my project gives me 0 NPV, it means that whatever I will earn, and I have, for example, if I discount it at 11.33%, so after discounting at 11.33%, NPV becomes 0. So it does not mean that project does not give any profit. It means that the company will not make any profit, because whatever returns will come in, those returns will be given to the investors. Nothing will be left for the business. Do you understand my point? So if I am discounting at 11.33%, NPV becomes 0. It means whatever project will give, that money I have to give it to you, and me as a business will be at 0. So this is the concept of discount rate, discount factor. Now you people have seen now how to, there are 2 words. One is called discount rate, which is 10%. And one is called discount factor. Discount factor is actually, if for this particular example, if I say, it will be 1 divided by 1 plus 10%, 10% power 1. So your discount factor is actually 1 plus, I'm sorry, 10%. I should have added 10%. I'm sorry, 1 plus what I'm doing, 0.909. So here when I put here, so actually what was happening, let me now show you. You had cash flows of 45,000, 45,000 and 45,000. And you multiply it with your discount factors. What do you multiply? Discount factors. And your discount factors are for year 1, it was, if you see here the formula, this was your formula here. If I put like this, remember this formula? And in year 2, you will put here 2. And in year 3, you put here the value 3. These were your discount factor formulas. So if I put here copy paste and I put the sign equals to, this is the discount factor. So I put it here. And now when you multiply it, 45,000 multiply with this number, you get like this. So you get the same numbers. You see your numbers were here for 10%. Okay, I put here 20%. Let me go back and change 10%. And I put here again 10%. And I put here again 10%. So either you divide it. So what I'm doing here, if you remember the formula, what was our formula? Our formula was, this was future value formula. Let me write down. This was my formula. So actually my formula was like this, and I can say that present value is equal to future value multiplied by 1 divided by 1 plus I power n. So it is the same thing. It is just a representation. Either you divide it with this number or you multiply it with 1 divided by 1. So this my factor, discount factor. How do I get my discount factor? Discount factor formula was this: 1 divided by 1 plus
I
10%, or whatever you call it, you call it 1 plus I power n. So this is the formula for discount factor. So you convert your discount rate 10%. This is discount rate. You convert it into discount factor. So it means that if I have to find out my factors for 10%, let's suppose, if I'm calculating my factors for 10% for year 1, year 2, and year 3, and year 4. How do you calculate your factor for these years?
1 divided by 1.
I will write it down like this: 1 divided by 1 plus this power this. This is this factor. And now let me just I'll lock the cell, lock these numbers, $49, and when I make, so you see that your factors like 0.751. So what does that mean now? These are the factors which I have calculated. These are called discount factors. So my at 10%, my fourth year factor is 0.68, right? So if you had a cash flow of 45,000 here, you multiply this number with this factor, and this would be the amount in the fourth year. So it means that 45,000 at the end of year 4, it is 30,000 of today, right? Okay, now one quick question, and then I will switch the topic. What is this 0.68? Who will tell me what is the 0.68? If I say that this 0.68, what is 0.68? Is it 0.68 kilograms, 0.68 centimeters, 0.68 liters? What is it? Yes, please. You people, have you people seen discount tables before or not?
I've seen it once.
Yes. Farooq, you have seen discount tables and discount factors before, yes?
Yes, sir.
So what is this 0.68? What does that mean? What is 0.68? What is it? Kilometer, liter, what?
It means the discount factor for 10% year 4.
Yeah, but I know that's the name, that's a discount factor. It means that $1 today will be 68 cents after 4 years.
Sir, inflation.
We take it for $1. We take it for $1 because we are dividing it with 1. So it means that $1 today is equal to 68 cents after 4 years. Now, if I have to extend this discount table, I'm sorry, let me extend it for 10 years. If I'm extending it for 10 years, and I also extend it for 10 years. So what do you get now here? The discount factor for the 10th year. For the 10th year, 10% discount factor is 0.38. It means that $1 today, it equal to 38 cents after 10 years. So if somebody tell you that he will give you 38 cents after 10 years, it is equal to $1 today. Or your $1 today, if you take your $1, listen, you take your $1 and you put it in some, I don't know, somewhere, and it remains there for 10 years. So after 10 years, then you will take out, it will be $1. But when you will go to the market, its value will be only 38 cents. You can make purchasing equal to 38 cents if your discount rate is 10%. Zishan, you wanted to ask something. कुछ कह रहे थे आप?
Inflation भी कह सकते हैं सर इसको. Inflation rate भी कह सकते हैं.
Yeah, that's what I said, that sometimes you call it inflation, sometimes you call it interest. It is not inflation. You can call it somehow. I mean, it's not the proper way of professional way of calling it inflation. You can call it that money is losing value with time. To some extent, it is inflation. So because of that inflation factor, your $1 today will be equal to. So if you people want to see, let's extend it. It will be interesting for you for seeing it for 15 years. Okay, let's make it for 15 years. And I will show you something. Now imagine that somebody tells you in 2034, which means after 15 years, you will be getting $5,000 salary. If you imagine that after 15 years, your salary will be $5,000, you will say, oh, that's a good salary. But then I multiply it with this factor. So it means that in terms of today, what you will be getting would be just $1,100. Do you understand my point? In terms of today. So that 5,000 which you will receive after 15 years, its today's value is only 1196. So either you get 1196 today or you get 5,000 after 15 years, it's all the same. Am I clear?
Yes, sir.
Okay. So now you have your discount tables. Let me now go to Google. The savior for everyone. I don't know if Google was not there, what would happen to the world? And you can imagine that when we were studying, there was no Google, there was no internet, there was nothing. So I go here. So I just wrote on Google present value table. Okay, let me call it present value table. Can you people see my internet by this screen Google, huh?
Yes, sir.
Okay, so we open up one table. I'm not sure if it is bigger enough to. So can you people see at 1% what is the value here?
Yes, sir.
So if I make it here, these are the values I'm making. So after 15 years, 1%. Oh, okay, sorry. I was doing it at 1%. We need to do at 10%. So if we make it here, after 15 years, it is 0.239. And what did we calculate? I think almost the same, yeah? Let's share our screen and see what did we calculate. 0.239. So these, what I'm trying to tell you, that when you see these tables are given at the back of your book, do not be surprised or impressed that these numbers are something very strange. You can make this table yourself. You can make this table yourself. 1 divided by 1 plus I power n, that's all. So if I see at 10% and 20 years, it is 0.149. It means $1 today, if discounted at 10%, if inflation is at 10%, just like our friend said, inflation, $1 today will be equal to only 14 cents after 20 years. Value is, you see, money loses value with time. Every year it is losing value. Every $1 is losing value. Your $1 is losing value. It is becoming smaller and smaller and smaller. Am I clear until here?
Yes.
Any question you want to ask, please?
No, sir.
Okay, we go back to our topic.
फॉर्मूला कैसे लगाया था आपने?
Sorry?
एक्सेल पे फॉर्मूला कैसे लगाया था आपने, ये बताओ.
Formula is like this one. 1 divided by 1 plus I
So the
power n. Screen share. Okay.
No.
Sorry. What did I share there? Is it share now, Excel?
No, sir.
Okay.
Yeah, it's shared. Yeah.
Excel, I'm trying to share Excel.
Yes, sir, it's shared.
So this is the formula. 1 divided by 1 plus I power n. This is called discount factor. That's how you calculate your discount factors. Can you calculate for 11% now?
Yes, sir.
We can calculate for 11%. I'll just put it here, and I will say here it is not J49, it will be K49. I put here K49. So this is the factor here for 11%. So if you are discounting at 11%, your, oh, wait a minute, what has happened? Okay, no. So let me write down 1 divided by 1 plus 11% and power year one power, and here I will lock this cell value, and then I say copy paste. So at 11%, the discount factors are even decreasing. As your inflation or interest rate or cost of capital is increasing, the value of money is further decreasing. So these present value tables you can create or make yourself. It's not a big challenge. Do you people have calculator?
Yes, sir.
Yes, sir.
Everybody please take out calculator.
Yes, sir.
So when I say 1 plus I, it means 1 plus 10%. It means 1.1, right? So I'm effectively saying 1 divided by 1.1 actually. 1 plus I means 1 plus 10%. 10 plus 10% means 0.1. So you can call it 1.1. Now, Farooq,
Yes, sir.
on your calculator, write down 1 divided by 1.1. 1 divided by 1.1. What do you get? 1.1.
1.909.
Don't delete it. 0.909. This is the same number here, right?
Yes, sir.
Divide again by 1.1.
0.826.
The same number?
Yes, sir.
Again by 1.1.
0.751.
So you can do it 10 times and you can make this table on your calculator also. It is so simple. 1 divided by 1.1, because 1.1 is that 10% you are adding. So you are actually decreasing the value of money with 10% every year. Because if you say 1 divided by 1, if I say 1 divided by 1, answer is 1. But when I say, if I divide 1 divided by 1, my answer will be 1. But I am saying 1 divided by 1.1. 1.1 means 10% further. So I am depreciating it by 10% every year. Remember your compounding, you are increasing 10% every year. In compounding, you are increasing 10% every year. In discounting, you are decreasing 10% every year. So you every year, you divide it with 10%.
Okay.
Understand?
Yes, sir.
1.1 means 110%. It is actually means 1 divided by 110%. It's all the same. So with 110% means that you are decreasing the value of money 10% every year. Are we clear?
सर ये एक्सेल के फॉर्मूले में समझ नहीं आएगी कैसे लगाना है सर हमने क्वेश्चन सॉल्व करना है ईयर 1 से ईयर 5 तक
तो ये लगा दिया ना, लगा दिया. ये शीट आपको भेज दूंगा, अपलोड कर दूंगा, शीट देख लेना.
ओके
फॉर्मूला ये ऊपर ऊपर आ रहा है ना, यू कैन सी इट. I just said factor up. How did I found factor? I just keep this lock so that every time copy paste should not make a problem. So I take this as my power. Okay. So let me show you again how I'm doing it. Let's suppose I have to do it because you people have to do it in Excel. Let's suppose you want to know it. So I say 1 divided by 1 plus this. I'm taking 10%. This my cell is giving me problem. Okay, let me put it here. Let me copy paste here, and I'll just remove the equal to sign. So this is my formula, and I'll remove the dollar sign. Do you know why do we put dollar sign?
No, sir.
Okay, dollar sign you put to lock some cell. See here, what is my formula? My formula says I'm actually doing 1 divided by, let me write it again, 1 divided by 1 plus 10%, this 10%, and I close it, and I put power. And in power, I don't write down 1, because in every cell because if I put here 1, when I will make copy paste, it will not work because I need this year. So I don't put 1, I say this one. So when I make a copy here, it automatically takes it 2. It takes the value of 2. Do you understand my point?
Okay, okay.
Otherwise, you have to do it manually. You have to do every time here 2, then you make a copy paste here, and you have to make here 3. So that will be difficult thing. So what you do, because in this you have to write down 4, here you write down 5, here you write down 6. So here in the very beginning, you just make a copy, this one, that power 1, power 2, power 3, and then you make a copy paste. That's all. Okay.
सर वो डॉलर डाल के मैं लॉक क्यों किया था?
वो लॉक इसलिए किया था कि वो वरना फॉलो नहीं करेगा. You lock it, this 10% should remain same, because if I do not make a lock, let's suppose I put it here, if I do not make a lock, let's suppose I remove this $sign. So values, the table will move because every time it will take this one plus this one. Okay, let me explain you. Lock, why do we do it? Let's suppose that you have, are you people listening? You have quantity and you have rate. Your rate is, let's suppose, rate per kilogram. Rate per kilogram. My rate per kilogram is $10 and my quantities are, let's suppose, I don't know, quantity is 100, 150, 170, 190. I want to find out that if every kilogram is $10, for $100, what will be the cost? What will be the cost? So what I need to do, I need to do this one, multiplied with this one, right? So you get $1,000. Do you understand here?
Yes, sir.
Now, when you will make a copy paste here, it will give you error. Because for this, it is saying this quantity multiplied by this, but when you go one cell lower, it will say take one cell from here. So because you went one down, one cell you went down, so it will also go one cell down and from here also. So I want that this 155. I want it to calculate 155 for this cell, but I want that this cell should not change. This should remain 10. So this is what you call lock. So now you do that when you make this formula, here you say, let's lock this M51, this column, this cell M51, you lock it. You say that when you calculate for here, you take this cell. This should move, but this should remain same. When you go down and you take it here, it is moving here, but it is locking this cell. So all of the values, here it is moving automatically, but this is locked.
Okay.
So when I was calculating for here, I locked my interest column. I said that interest will always be 10%. This value should change 2% 3 years, because if you see here, it says here, it took this one. In this, it took this one. But my interest rate is locked. Interest rate column is not changing. Interest rate cell is the same. These cells are changing. Okay?
Okay, sir. Thank you.
So that is a little bit of Excel thing. Okay, we will call it a day. That is enough for now. I will upload this lesson and we'll continue this topic next time. Okay. So please start reading your chapter number 8, which is discounted cash flow. Read the chapter and we will continue in next lesson. All right.
Okay, sir.
Okay. Thank you. Take care.
Okay, that's it.